Welcome back. You're watching The Money Show on ET Now. Well, last week you just heard out Shakti Kanta Das and his team saying that, look, we're not going to change the repo rate. It's still going to be at 5.15%. And as we on The Money Show have told you during every RBI policy decision, it does make a difference to your EMI as to what Shakti Kanta Das and his team do announce. But it looks like slowly and steadily, banks have been cutting their MCLR. That's basically the base rate on which your EMI interest rate is dependent on. So what exactly, you as a borrower, what should be your strategy if you have an existing home loan or if you're looking to take a home loan? How should you go about it? Which banks are giving the most competitive rates, especially because we have seen the repo rates really fall. Look at that, from 6.5% in August 2018. Now we're just at about 5.15%. So let's bring on board Naveen Kukreja, the CEO and co-founder of PaisaBazaar.com. Naveen, thank you so much for joining us on The Money Show. You guys have so much data at hand available. You'll have been getting banks, financial institutions, NBFCs, housing finance companies, you take all of their interest rates. What is the general trajectory you're observing? Have they been passing on this interest rates to the customers? Because we do know for a fact that you have, on one side, the State Bank of India's and the other PSU banks who, religiously pass on and cut the MCLRs and, pass on the interest rates to the customers. What about the other banks? Have they as well been seeing that? And now, it's been a year, right, since August 2018 that there has been this rate cutting spree of sorts. Do you think that whatever the RBI has announced, the entire rate cut has been passed on to the customers?
Thank you. So, Mubina, as you mentioned, the MCLR has been going down for the last 1 year or so. Over a period of time, what RBI has done and how the housing regulation has moved is that most of the home loan rates are now linked to the cost of borrowing. So, in that sense, it's become very transparent. However, the cost of borrowing for the banks, MCLR or what they borrow from RBI is only a component of that, and the eventual cost of borrowing is considers into account various factors. So the banks in general have passed on benefits in terms of home loans becoming cheaper. However, you might see a different rate of reduction for different banks depending on their cost of borrowings. So I would say in general the cost of home loans has come down between 60 to 70 bips over the last 1 year. From a consumer perspective, what I would suggest to any consumer is that if you have a home loan running, what you should do is you can come to a site like ours or any other site which you trust, where you basically are able to see options available to you. For example, we would be working with 30 plus lenders. So in 2 to 3 minutes, you can basically compare all the pricing and see whether you have a good and competitive price or not. If you don't have a competitive pricing, and if you have a large home loan amount outstanding, I would recommend you to consider switching, because as per regulation, RBI does not allow any prepayment penalty. So you would not have to pay prepayment penalty if you were switching your home loan.
Okay, understood. So basically, you simply just go on to PaisaBazaar.com, you compare what the interest rates are, that may be an SBI, HDFC, Bank of Baroda, PNB, so on and so forth, charging, and you could consider switching over. A very important piece to note as well, the bank will not charge you any prepayment penalty. That means you can actually pay off the home loan that's pending at a particular bank. And then, of course, you can take, it'll be the other way around rather. You'll take the loan from the new bank, which perhaps is charging you a lower interest rates, and then pay off the entire loan that may be outstanding at your existing bank. And then, of course, you can enjoy a lower rate. Now, as we know, Naveen, there's a loan linked to an external benchmark. Then there's the MCLR loan. You have the repo linked loans. Which one of these categories has actually been most efficient in transmitting the lower interest rates to the customer? So let's say if I'm an existing home loan or personal loan or car loan customer with a bank, which category has actually seen the most reduction And also, would you recommend that if I am, let's say, going, to the bank to ask for a new loan, which one would you recommend they choose? Because there are so many kinds, right? I mean, fixed, of course, is something that's very simple to understand. But within the whole floating rate category, we literally have now 2, 3 with the, RBI also introducing repo linked. So what would be your recommendation there?
In the home loan specifically, firstly, I would normally recommend a variable rate to the consumers and not a fixed rate, because a fixed rate home loan can technically have prepayment penalties unless you're getting a great deal. So, for example, I know that somebody like an SBI used to offer great deals on SBI fixed rate loans some time back. I don't think that's available right now, and in general for the consumers also, in a falling interest rate scenario, it's better to go for variable pricing. In terms of variable home loan rate, from a consumer perspective, because this becomes very technical jargon, usually the banks would now be offering interbank linked rates. So the consumers, my suggestion is go for variable rate, and if you already have a home loan, look at what the current interest rate is. In general, if the home loan interest rate is more than 9% in current scenario, there is a case for converting your home loan or moving your home loan. But the starting point of that should be, speaking to your current home loan provider and figuring out with them whether they can reduce your interest rate, or if they can't, then exploring your options. But currently, in terms of the specific pricing, the external benchmark linked rates should be the best format to go for from a consumer perspective.
Okay. Now, this would be still, even though there are a lot of jargons involved, this would still be relatively a little easier to understand. I think something that Shakti Kanta Das has done on Thursday is also with respect to the CRR, easing the requirement of the cash reserve ratio for, certain kinds of loans. And many believe that this will also help lower the cost of borrowing then for customers. If you could just explain that as well to our viewers, which car loans could we expect could get cheaper because of this easing of rules with respect to CRR?
So, as you said, the name is cash reserve ratio. So, basically banks are required to keep a certain amount of cash basis their balance sheets, and what the RBI governor has done is that on certain kinds of loans, they have reduced the cash reserve ratio requirement. So basically the banks for those loans will need to keep less idle cash. What that means is that if they need to keep less cash with RBI, basically they can use that cash for more economically beneficial uses like giving out loans, etc., which means indirectly it impacts the cost of borrowing for the banks. It lowers the cost of borrowings. So hopefully some of that will start to pass on. Like I said in the beginning, the cost of borrowing for a bank is made up of multiple factors. The benchmark rate is one of them, CRR is another one of them. So as that reduces for the banks, some of that should start to reflect on the home loan pricing. But in terms of the passing on the pricing, we usually see the most transparent passing on of the pricing in the home loan segment, followed by car loan possibly. The personal loan and unsecured loans are very much risk based pricing, so I would not try and assume what the banks would do on the pricing there.
All right, fair enough. Now, of course, while on one hand you may have the borrowers rejoicing that we're getting loans at lower rates, on the flip side you have fixed deposit guys who may not exactly be on the same side of the party. And now I see there are certain banks that are offering a fixed deposit interest rate of only about 6.5% on a 1-year basis. In fact, even lower than that, maybe for an SBI, etc. Naveen, where are you seeing? I mean, you can't help but investors, FDs still are the most favored route to save money, and you can choose the tenure that the money is locked in as well. So investors can't help but look for the rates that look very attractive. So Naveen, which banks are still offering a little bit of an attractive rate? Let's just assume if it's still a 1-year FD.
Yeah, as you said, as the rates are falling on the lending side, so would the rates be falling on the fixed deposit sides. So the same banks would tend to have lower FD rates. However, because of what's happened in the banking sector, because of the small finance banks, which are newer banks and hungry for deposits, consumers have a little bit of an advantage there if they're smart. My suggestion to consumers is that do the same thing that I asked you to do on the loan side, which is essentially go to a comparison site or do compare digitally some of the fixed rate pricing that some of the newer banks, whether it's new banks like IDFC First, Yes Bank, or especially the small finance banks who are newer banks, have lower balance sheet, are hungrier for fixed deposits. They would be offering as high as 8% of percent on the fixed deposit. So my suggestion to the consumers is that do look at the small finance bank as one of the fixed deposit options. Of course, I would recommend to consumers to look at mutual funds. That continues to remain the best avenue to invest, but I do understand that some consumers might be very, very comfortable with fixed deposits. If you are in that bracket, do look at small finance banks and some of the newer private banks. They'll be offering higher rates than some of the larger banks.
Okay, great. Well, there you have it, folks. That's essentially understanding the implications of the recent RBI announcements and how, of course, banks are now passing on the lower interest rates to you, the customer, as well. Okay, we've got a couple of viewer queries, which, I'd like to ask Naveen to, of course, request him to answer them. Srini from Dubai is writing into us. He says that I wish to take loan mortgaging my shares in my demat account to reinvest the loan amount in equities. He wants to know now which loan is best suited for this. So essentially, he just wants to mortgage off the shares that he already has to invest a little more in other shares. He's perhaps finding a lot of potential in this market. Yeah. So Naveen, what would you recommend? What sort of a loan would be most suited for him?
Before I recommend the loan, my first recommendation is that never borrow to invest back into equities, because it's equity is a very, very long-term investment. In a short term, it can have high amount of volatility. So I would never recommend borrowing to invest back into equity. However, to answer the specific question, there are products which are available which allow you to borrow against your securities. So almost all the banks and large NBFCs should have that product. Typically, they would allow you to borrow about 50% of your capital value or assets value, and depending on the risk segment that you are in, you could get that loan, and the provider, you could get that loan from as low as 11% to going up to 14-15% per annum. But as I said, if you're borrowing at about 11-12% and to invest back into equities is not a recommendation I would make. Secondly, usually the brokers, equity brokers, that all large brokers also have a concept called margin investment, which is nothing but basically borrowing from the broker to invest. Because they are not large banks or large NBFCs, the brokers would typically charge a higher interest rate. It could be as high as 18-20%, and you can borrow on margin to invest back. So these would be the two options which you could use technically to invest back into equity. However, stating what I stated earlier, my advice is not to borrow from the markets to invest into equities.
Okay, so a disclaimer, of course, not exactly the best idea. Financially, not a prudent practice to borrow to invest in equities. But of course, the decision is yours. And Naveen has, of course, given you his advice. But you know what? Unfortunately, we're not going to be able to take any more queries. So we'll leave it at that. Thank you, Naveen, for joining in and breaking it all down for our viewers. Where can they get the best deals when it comes to home loans, car loans? Especially since, of course, the RBI has made it easier as well for the customer to borrow. I wouldn't say the same for fixed deposits, but hey, that's what mutual funds are for, right? Anyway, we will take a very short break on the show. Should we do that or? Okay, you know what? I don't want to take a break right now since we are on the topic of course, the RBI announcements. It's essentially important to understand, especially for those guys who have debt mutual funds, which I'm assuming many of you do have, since a well-balanced portfolio is something that does have a little bit of equity funds and a little bit of debt funds as well, pardon me. So what exactly do the RBI announcements mean for debt mutual funds? Because there was a lot of announcements made which would essentially enable liquidity, the cash reserve ratio requirements being lifted for certain kind of loans as well as something that would enable liquidity. And of course, it may sound a bit jargony for a lot of our viewers, but fixed income and debt funds are essentially filled with a lot of jargons. Nevertheless, let's try and de-jargonize that for you. I have with me Devang Shah, the Deputy Head Fixed Income of Axis Mutual Fund, joining in right now on the show. Devang, thank you so much for joining us on The Money Show. Whenever the RBI does make some announcements during their policy, it does have implications for bond yields, which in turn affect debt mutual funds, from the short tenure funds to the long-term funds. Now, I want to start off by talking about this new tool the RBI has introduced called the long-term repo. What does it mean for banks and also subsequently for perhaps even the bank's customers? If you could explain that first to us in simple terms, and then we'll move on to the impact on debt mutual funds.
So see, RBI has announced this long-term reverse operations, and it's a very, very innovative tool. In simplified format, what RBI is telling banks is that you can come and borrow against GSEC from me for 1 year and 3 years at 5.15, which is the repo rate today, and lend this money into the system. So this is very, very positive for banking segment. It adds to significant banking liquidity. Secondly, it also helps for credit transmission. And thirdly, I think it is a very, very effective tool for getting the lending rates lower. So in summary, it is beneficial for banks on a total basis to borrow at lower rates, and for the end borrowers also, the rates would come down. That is what we believe so.
Okay. When the RBI made these announcements, we saw the 1 year and the 3 year yield spike significantly. Again, just to understand it, for our debt funds, what does a spike in these short term, you could call 1 year and 3 year yields short term, what does that mean for the different categories of debt funds that are out there?
So I think last month, post the announcement of OMO twist, where RBI was selling the short bonds and buying long bonds, we had seen some kind of spike in the short-term bond yields. Post this announcement of LTROs in the monetary policy and various other measures which RBI had taken, including a very, very dovish, I would say, forward guidance, they communicating that there is room for rate cuts available. Incrementally, there are various steps which RBI is also taking, like reduction of CRR for various retail assets. Similarly, going away or deferring the NPA recognition for commercial real estate and MSME. So I think on an overall perspective, RBI was very dovish. With this long-term reverse operations being announced up to a tune of 1 lakh crores, I think we believe that the short bond space will rally from current levels. Already since policy, we have seen a 20-25 basis of rally in 1 to 3 year bonds. We believe so we can see another 10 to 15 basis rally from here on. Very, very positive for the short bond space.
Okay, excellent. And yeah, you mentioned Operation Twist. Even that was essentially to reduce yields on corporate bonds. So I want to talk about that segment of debt funds because a lot of viewers, may be interested in corporate bond funds as well. How do you view corporate bond funds in terms of return potential?
So our view is that if I look at the macro analysis today, we believe that growth continues to hover sideways. Yes, all this directed push of credit, all the measures taken by government will start seeing some impact on the growth. But I think growth recovery is somewhere down the line in H2 FY21. Similarly, on inflation perspective, yes, near-term inflation looks on the higher side, but on a medium term perspective, we believe that both core and headline inflation will continue to hover between 4.5% to 5%. In this backdrop of macro analysis where growth continues to remain weak or at the cusp of recovery and inflation well under control, we believe that RBI would be on a pause mode for most part of this year. With announcements like LTRO, possibility of rate cut, forward very bullish guidance, we believe that the short bond space can rally more. Even the long bonds, the entire fixed income space can rally from current levels. So at this point of time, yes, our understanding is that the entire fixed income curve looks very positive. Corporate bond spreads are very attractive. If you look at 3-year corporate bonds, 10-year AAA corporate bonds, as well as 2-year, 3-year AA bonds, I think the spreads over overnight rates are very attractive. If a bank is getting up to 1 lakh crores of money at repo rate, and if 2-year, 3-year corporate bonds are traded at 620, 30 levels, 10-year corporate bonds are traded around 7.25, and 2-year, 3-year corporate bonds are traded at around, AA corporate bonds are traded around 8% plus, I think today it makes a lot of sense for investors to capture corporate bonds into the short to medium term space, including credit.
So, Devang, just to summarize it for our viewers and to make it simple for them, now, given whatever the scenario looks like you mentioned, growth is weak, inflation is, within range, so RBI will not cut interest rates. For an investor looking to invest in the debt mutual funds, like I mentioned, there's low duration, long duration, gilt fund, corporate fund. What sort of adjustments would you recommend based on the current environment?
So our view is very bullish at this point of time. I think the budget, government just did the 0.5 breach of fiscal deficit, which was within the FRBM Act. The monetary policy was a big complement to the budget. The entire push was on credit, improving banking liquidity, flow of credit to the economy, as well as ensure that transmission of rates happen from here on. So we are constructive onto an entire fixed income segment. I think the short bond space and credit funds makes a lot of sense for us at this point of time. So in our portfolios, we have added, we already had a very high core portfolio onto 2-year, 3-year corporate bonds. We have added more 2-year, 3-year corporate bonds, both on AAA and AA. And we believe that there are tactical opportunities also onto the long bond space.
Okay, so again, RBI has essentially kept rates as is, stance is accommodative. What sort of duration mix of debt funds should individuals have of their debt, of all of the debt funds? How much should be in long term? How much should be in short duration? Give it to our viewers.
So I continue to advise clients to stay invested into short to medium term space, because we believe that for most part of this year, RBI would continue to be on a status quo mode or a pause mode. Yes, we can see one rate cut, but post that we don't believe that there will be too many rate cuts, as well as we don't anticipate any rate hikes too in this year. So in a pause kind of a scenario, we continue to advise clients to stay invested into short to medium term duration funds. Because we believe that we are at the cusp of recovery when it comes to the growth cycle, as well as the credit push which has been given by both government and RBI. I think the credit cycle is on the uptick. Spreads are very attractive. Investors should also allocate to short duration credit funds. So these are our advice at this point of time to investors.
Okay, short duration credit funds, that's where you could put a nice chunk of your money in to look for some return potential, according to Devang. Thank you so much then, Devang, for joining in and helping our viewers understand how they can make money post the RBI announcements. Okay, well, folks, on that note, we will take a very short break. But when we return in our Spend with EMS segment, we're going to help you buy luxury without spending off half of your salary. How, you may ask? Well, stay tuned to The Money Show to find out.